Okay, welcome to Module 8, Large Orders, our first of the series of trading strategies and order types that we see on the price ladder and pattern types, and then really how to design your appropriate trading strategy to optimize your profit performance in extracting the most out of the market when you see specific types of order flow patterns. Now we're going to have a look at the content structure of this module. Firstly, slide 3, we look at that framework, that knowledge framework, in order to compartmentalize our learning. And slide 4, we'll be looking at the module breakdown of the rest of the large order module. Slide 5 to 6, we start defining what is a large order. Slide 7 are the trading strategies around large orders. And then slide 8, we unleash you into the market with a structured process of extracting the most information in developing various types of strategies around large orders in a very structured learning environment. Okay, in this section of the drop-down, the top-down approach of observing your market participants, then seeing what execution strategies the various market participants execute, especially the larger time frame or the bigger players, then how, once you observe the various different types of execution orders, what type of trading strategies you're going to deploy, and those trading strategies will be very dependent on the market environment that they do exist. So in this part of the module, we're looking at large orders, and the trading strategies will be your certain front run vanilla strategies, the fill and run, the fast sprint, the hit and run, and the hiding behind the elephant. And we'll be touching on some of those in our video. We'll be looking at a couple of those, and the rest you already start developing your own patterns in the large order space, and really what optimum market environment do these exist in. Okay, now the module structure for the rest of the large order module. So we'll be going through one main learning video looking at multiple large order plays and setups and strategies. Then there'll be 5 replay drills. We'll have a Q&A session to consolidate your learning. We'll be looking at 4 strategies within the large order play when you observe one, identify one, and then there'll be one key worksheet exercise on how to really consolidate your learning in the live markets. And we'll be looking at the optimum market environments in each of those plays and setups, and how to deploy the right strategy as you identify these large orders. Okay, now let's define what is a large order. A large order is an abnormally large order sitting on the order book. As you can see in the image, at 167.44, there's a 2,300 lot. If you look during the entire length of the buy side orders, there isn't an order greater than 600 lots. So this 2,300 lot is almost 4 times larger than any other order on the order book. So extremely, this sits out like a sore thumb. A large order always sits out like a sore thumb. Then the next question is to try and determine what type of trading strategies you want to really deploy. So now, a basic definition is you can have a rudimentary definition of twice the size of all the other orders. So in this context, although we have a 2,300 lot, if that was a 1,000 lot, that would by its definition constitute a large order. Now, how do you measure the genuine nature of a large order? Now, what's really important is the genuine nature, meaning that large order actually wants to be filled. So it's not a flipper, or it's not a flipper or a spoofer who doesn't have the intention of being filled. It is actually an order that wishes to be filled. And most importantly is the duration. If the large order has been sitting on the order book at that price for the entire morning, or you saw it prior to futures open at a key level, then that has a strong nature. If you just see a large order appear out of nowhere at a price while the market is trading, then there's a strong likelihood that that is not a genuine large order. So a large order is a large order that has been on the book for a large duration has greater odds of being genuine. Also, what's really important is trading is the contextual approach, or the speed towards the order. the faster, the further away the market is away from a large order, and the faster the market moves towards it, the more the market will possibly react. Whereas if a market trades above that large order for a period of time, the greater propensity of that large order could be traded out. But if it's a genuine order, well, then there are a whole myriad of different trading strategies, which we'll be speaking about in a video after we look at the trading strategies section. Now remember, the main reasons for large orders is there's countless reasons for large orders, but a lot of them are for genuine orders from a broker who's looking to execute for his client at any particular price. A lot of times those large orders happen of certain events, which we'll talk about a little bit later on, but there is a whole bunch of reasons for large orders, and we'll look at that in the next slide. Okay, some further definitions of what a large order is and when they do exist. Now, large orders are most frequent and real when market is in a high state of panic, when there is a breaking geopolitical news or fundamental panic event. So when the market is really gyrating and moving aggressively, if there's a war outbreak or a terrorist attack or emergency interest rate meetings, then what happens is the entire, large time frame institutions have to start getting orders away at whatever price. And for local intraday traders, the moment you see those genuine large orders, you can really profit from them by observing them quickly on the ladder, executing quickly in front or behind them, or when those large orders get taken out, when you see the market blip in a direction. But those, you have to be aware. If you know when those large orders do exist, you're able to react a lot more quicker. So generally, your large orders are most genuine in a very high panic state, state of the market. Now, the entity executing the trade, so whether it's the high frequency institution or a pension fund or a hedge fund, the entity needs the order to be processed immediately due to either margin calls, so the entity has to exit their position because they've been on a continuous losing streak and now they've received their margin call, or there's a client urgency. The client wants it at any price. He wants to get in on a trade because he has new news or new revelations, so he wants to get in on that order at whatever price. Also, if there's rapid new information in the marketplace, if all of a sudden inflation figures spike and the bond markets start gyrating and become very volatile, then this is new information. Then you get these new large new information. And then level 3, also just to let you know, level 3 data to see the depth of the order book for one player and large associated orders. So that just means that level 3 data, when you can see what's the composition of that large order. If that one large order is just one player, and so say 2,000 lots of that order, there's 1,900 is just one participant, the other is 100 lot. You do know that that is one genuine person that wants to who wants his order to be filled. So the important thing is now what trading strategy to deploy when you observe a large order, and we'll be speaking about those trading strategies right near the end of this module, just before the live trading drill exercises. And really rather important, the most important thing when you see a large order, especially if you're engaging in a front run, which we'll be speaking about specifically in a little bit, is the first in, first out principle. The moment you observe that large order, it's your ability to get in quickly. You can create alerts on your price ladder space to bring your attention to those large orders, or just your peripheral awareness and your understanding when you observe those large orders. How do you Okay, now the exciting part, trading strategies around large orders. The objective when you observe these large orders is to front run genuine large orders for an highly leveraged profit. We have some of our traders here at Axia Futures who will observe large orders in some very thick liquid markets, and what they try and do is they have a one tick risk and a one tick reward, but they're doing it with such large size. For example, in the treasury market, if they see a 4,000 genuine order, 4,000 lot genuine order, and with that 4,000 lots that they then execute a front run trade just above it, they're looking for one tick, and they'll do it with a 200-300 lots sometimes just for that one tick. And so it's a very highly leveraged trade, provided your experience and your ability to interpret what is a genuine large order and what is not. Your ability to interpret that will determine the success of your trade, and that's only a process of observation and experience and solid deliberate learning. Now, we're going to be looking at a couple of strategies in the next slide on some videos, but we're going to be looking at some front-running strategies, and the main ones really is, as I mentioned before, the explosive one-tick front run. It's the fill and run. So the moment you see that large order, so for example on the previous slide we saw that 2,000 lot, the moment that comes in, you determine that's a genuine order. You place a bid directly above it. The moment you get filled, you get out for a tick or 3 ticks, and so really the mathematics of that trade is you leveraging your size in order to get the full, given the type of liquidity environment that you have. And a lot of times large orders come in when the market's in that high state of panic, and the moment you see it, sometimes large orders start chasing the book up the page, and you'll get it sometimes when there's an OPEC breaking meeting on crude oil, when all of a sudden you see a large order coming to the market, 1,000 lot, and what you do, you place an order just above it. So 1,000 lot comes in on the buy side, you place an order just above it, and then you get filled and the market moves up, then all of a sudden the 1,000 lot is not being filled, it chases up the market again, it's not getting filled, so you run in front of that order. Sometimes you can get a quick 20-tick move when you notice a large order not being filled. Those are sometimes the best trades when a large order excuse me, is not being filled. And then there's the front run positioner after a fast sprint. We won't be looking at a video. I'd rather let you find this in the marketplace, but effectively what that is if you've had a large order sitting at a particular price all day and therefore kind of ticks the box of a genuine order, what you're effectively looking for is if you see the market moving 50, 60 ticks, say in this instance in the oil market, moving incredibly quickly towards an order. If that market is moving very quickly towards a large order, there's a very strong likelihood that the market will bounce directly off that large order, because it's not moving towards slowly, it's not building time above that large order, because the moment you build time, there is a lot of energy for the market to trade through it, because it's building a good structure above it. So when a market almost vacuums towards the level, moves fast, it's easier to bounce because it's moving from far, whereas when it's moving slowly towards it and builds above it, it's not going to bounce as quickly because it's not bouncing from far, it's bouncing from close. So those fast sprint large order trades are some of they don't exist too often, but when you observe them, they are great trading strategies and high probability plays. And then there's the hiding behind the elephant trade. So once the large order has been identified and the large order, the front run starts failing, and all of a sudden you start seeing participants hitting that large order, or that large order starts disintegrating with trades that are going through it. The moment you see the large order just about to disappear, you have to react quickly enough by, in this instance, say if the large order is a 2,000 lot sitting at a bid at 50, the market is bouncing off it, but eventually the market starts trading out that large order. The moment it trades out, the market blips down. The moment it blips down, on the balance of probability, what happens is it blips down because everyone's having to start covering who are front running. It blips down, and then you have to wait until you find that first little absorption zone, which we'll be talking on the later on in the module. The moment the market blips down and you see the market starting to reload on the buy side, you hide behind that large order, you bid it, and then invariably the market retests where that large order was taken out. So that's called the hiding behind the elephant, and we'll be looking at in the next video after this slide. And then you can get synthetic scalps via TT. You can have more automated strategies, such as you can have the same type of hiding behind the elephant, or if you hit the large order. So for example, if you're looking to hit the large order and the large order disappears, and the market blips down, as soon as you hit that large order, as soon as you get filled, you have an automatic exit. So the moment you get filled, you put an automatic exit for that quick fill, because the market can react very, very quickly. And that we'll talk about the hit and run plus a quick synthetic exit. So the hit and run strategy is you observe the large order, the people are unable to front run the large order is now being traded out, you join as that large order gets taken out, you follow that large order, and we'll be looking at in the next video, the video analysis of the ladder of a large order hit and run strategy. And as that large order gets taken out, it blips down. But this will make a lot more sense when we look at the ladder video next. Now the exciting part, the live drill practice. I want you to find 60 large order plays in the next month in the live trading markets on the simulator that you've been provided. And look at the trading strategies you will be executing from the previous video we showed of the various different trading strategies and how to utilize them, and then how you can optimize it in your own way, in your own method. Need to fill in the sheet provided, so you need to click on that link. And the important question, also ask yourself, did you create any of your own? Now on that sheet you have to specify the date and the time that you saw the order, what market it was, what was the average bid and size of the offers. So you start really climatizing, understanding your various different markets that you trade and their average the average order size, and then what was the size of the large order, and then how long was the large order there on the book, what is the duration, was it there from the beginning of the morning, did it appear out of nowhere and therefore it got the order got pulled. What was the market volatility environment? Was it a very high active environment? Was it a very low active environment? So these are all important. And then what was your execution method? Did you utilize the hit and run method, the vanilla front run? Did you hide behind the elephant or hide behind the large order? And then what was your learning outcome? So all very important to record that in order to optimize your learning experience. And what you're looking for is leverage 1 to tick winners on the thicker markets, and then 5 to 10 tick winners when the markets are moving a lot faster. So when the markets are moving fast towards a large order, you want to expand your profit potential on those trades. So click on that worksheet and unleash yourself in the large order practice over the next month, and just look for those large orders on the order book. And all the best and good luck.
Welcome to our large orders trading strategy video. In this video we'll be looking at the oil market, which is depicted here at this on the left hand side, this ladder over here, and the market is currently trading at 50.29. 19 lots bid at 15.29 with 28 lots offered at 50.30. So if you wanted to buy here at the market, you'd have to enter your position right over here at 50.30 at market. You could take as many as 28 lots at this specific point in time. If you want to sell the market now, you'd have to sell at 50.29, and those are your currently traded price. And as you can see, this is the depth of market, this is the order book on the buy side, and this is the order book on the sell side. So now we're going to be having a look at this video, and we'll be looking at a large order trading strategy. So let's play. I'll be playing this at 4 times the speed so we can get through the crux of the video. So let me just, now what we have over here is a triple whammy crude oil front run play. So a triple whammy play because we are looking at 3 potential plays over here. Now the first one we're going to be doing is identifying a large order. At the moment you can see the order book is really the size of the orders on the order book throughout these prices is between 20 lots to around 90 lots on either side. So no significant large order that we're able to identify at this moment. But what we'll be looking for is a large order. As you'll see as I press play again on the video, you will have 3 strategies that we'll be trading here. Firstly, the front run explosive grab. So the moment we see that large order come onto the book, so if we see a large order come to the book, we can start positioning and start putting our orders just above that large order, between a 1 to 3 tick or 2 tick position above the large order, or if the large order comes on the sell side, 1 to 2 to 3 ticks below the large order on the sell side. Now for that front run explosive grab, what you're looking for is the moment you enter the trade, the moment you get filled, you want to try and enter it with a rather aggressive size, and you want to take anything between 1 to 4 ticks on the trade, or 1 to 2 ticks on the trade, depending on the genuine nature of the large order. A large order that appears out of nowhere in the oil market that's above 500 lots is generally on balance of average a significant order, especially when the market is moving around quickly. As you notice when you're trading products such as the Bund, and you see orders flashing in and out, large orders that are twice the size of the order book, sometimes those are not genuine orders, and front run strategies would not work. Now your reward management is, as I said, 3 to 6 ticks. Your risk management, what you're doing is, if you see a large order on the buy side, and say in this instance you saw it at 50.27 over here, what you'd want to do is ensure that you put your trade, the moment you notice a large order, you want to make sure you get optimum queuing. So if you saw a large order at 50.28, you'd want to then put your order at 50.29 and potentially 50.30. So the moment you see the large order, you front run that order, and the moment you get into the trade, you're looking for a quick reward. A quick reward exit. So that's for your front run explosive grab. Now what we're going to be looking at in this example as well is the hit and run. So the moment the front run opportunity starts disappearing and the market starts trading towards the large order, so when you start observing the large, and we'll see this all in a very short while, but the moment you see that the market is starting to struggle to trade away from the large order and the market wants to start trading the large order, what you want to notice is as the large order starts disappearing, as the participants start hitting the say the bid in this instance, the moment the large order starts disappearing through traded orders, you want to get on the back of that, and it's called the classic hit and run. So as you see it diminishing, you don't want to hit it first up immediately because the market could still trade away from it, but as you start seeing this order disappear, then you're looking to hit it and automatically start placing some bids on the buy side. So you exit very quickly, because the moment that large order gets taken out, the balance of probabilities, you'll get a blip towards the downside, and as you get that blip towards the downside, you want to start getting out of your trades immediately, and your exit, the environment on this again is you're not too worried on the environment, but ideally actually higher volume volatility environment. You want to see the order being taken out quite aggressively and quite effectively. Then what we'll be looking at, as this large elephant order has been hit, a lot of the times what happens, it blips through, and then you have a trading strategy what's called hiding behind the elephant, so the large order being the elephant, and as the market takes it out, you'll get an initial blip down, then you're looking for a bit of absorption play. So it's a trading strategy that we observe later on in the modules, but effectively, in a just quick summary, is just looking for someone reloading on the buy side. When someone is reloading on the buy side, then the market likes to come and test that price where the large order is effectively. So the moment you hit it, you want to be finding your exits and potentially looking for a cut and reverse, and you're going long and you're trading back towards that large order price that got taken out. So it's a whole, there's 3 trading strategies over here within that one genuine large order that you observe, that you want to keep a very close eye. Now, those 3 trading strategies don't have to all happen at once. The reason why they don't have to happen all at once is simply because sometimes when you see a large genuine order, the market could just get chased all the way up the order book and never revisit that price, because the market's in a highly volatile, highly geopolitical occasion potentially, where the market is just finding one directional play, and there's the panicked brokers who are having to get away orders at whatever price, and they're putting in the large orders at whatever price, and the market just starts feeding off it like a frenzy and just starts trading away, and you actually don't have the other 2 strategies, such as the hit and run or hiding behind the elephant, where the large order just actually results in a market moving in one directional play. So now let's have a look at this video in real time, and let's really watch the order book very closely. So as you can see at the 25s, right there at the 25s, you can see a large order that has come onto the order book over here. So you've seen that large order that's come onto the order book. So what you're doing immediately, you want to put a buy order at the 50.26, because it's just come on in the order, and this is really an incomplete anomaly size. I mean, look at the difference between 2,077 lots at 50.25, and everything below that is below 3-figure digits. So really large, extremely large size. So you're potentially putting a bid at the 26s and at the 27s. So now let's have a look how this market really starts evolving and developing over here. So the market is trading above it. Now the market's obviously observed this, and it's trading a little bit, trading up the page. And as you can see, for the moment, that the market is moving away from this 50-25. So we're watching really closely here of how this market really how the market really observes this large order and what it wants to really do with this large order. So we're now trading 50-35 at the moment, trading 50-35, bid 34, offered 35. So this market is still trading about 10 ticks away from this 50-25 over here, and it's trying to move a little bit higher after seeing that large order, as you can see. So we're just watching this here, we're watching that large order, we're watching interaction of all the other orders, observing that large order. Now the market's trading 36, now the market is trading 36, trading 35 there. Now you've seen the order, there's a new order that's moved up the book. So potentially, because this order is not getting filled, the person who's executing this order is having to now chase the market, so potentially has moved the order up the order book. And the moment you see that, you want to be getting some orders in at 36 over here, and actually going in at market at 37. So you'd be able to get 37. So the order has just increased. So there could be potentially a 2,000 lot still over here, but we've seen the market shift up towards really at market now, waiting to get its full at 50-35. So it's how the market now responds to this, and you'll get some potential front running from traders around the planet, putting some orders at 36 and 37, looking for leverage front run and potentially getting out for just a couple of ticks. So just front running this large order over here on the price ladder. So let's see how this now materializes as we start watching this 50-35, there's 520 lots here at market. So you can see at the moment, you could 30, so it's gone up to 38, traded out 39. So already your front run trading strategy would have worked there for a couple of ticks, 3-4 ticks at the moment, 45 ticks at the moment. Now it's 2,000 lots. You can see that 2,000 lots. So are you putting some orders? Are you ready? You've chased orders. You would have been filled at the 37s and the 36 as the market trades up a little bit higher. Now we're seeing that the market is not escaping as quickly away from this order, but we are, if you are scalping around this area in front of this market, but it's not exploding up towards the upside. So we're keeping a very, very close eye if the market wants to come and gravitate towards this 50-35 and wants to start trading out this 50-35. So keeping a very, very close eye on how this market starts evolving and developing and how it wants to trade towards. And if we start seeing a potential hit and run pattern that will emanate from observing this. So we're just keeping a close eye on this. So we can see now we're trading very near the 50-35 at the moment, very near it. So we want to see if it starts trading it now, and if it starts trading it, we have a potential hit and run strategy in the making. So as you can see, we traded a couple of lots at the 50-35 offering down. So you'll see we're starting to trade a few more lots, but nothing significant at the moment. We want to see a little bit more size hitting this 50-35. It's still holding above, the 50-36. People are still buying or front running this large order. You can see now you can really see now that it's a genuine genuine large order, because it's accepting being traded into. That's how you really start defining a large order. The moment you start seeing it generally being traded into or holding its ground and not flipping or disappearing, you know it's a genuine large order. So we're still watching. The market is still holding a bid at 50-36, and this market now is still trying to work out if it wants to trade out this 50-35 for the moment. It hasn't traded it out yet, so we're slowly observing this market, and I just want you to keep an eye. Okay, now let's keep a close eye on how this trades over here. So a couple of lots are hitting this bid at the moment. You can see a couple of lots more hitting this bid. We're watching it closely now. And then you can see, and this, remember, this is there we go. You just saw a couple of 200 lots. It's just taken 300 lots over there. So at this moment, you potentially, the moment we start seeing this, for me, my rule of thumb, if it's above 1,000 lots, the moment I start seeing the acceleration of the hit, I'm going to start joining this hit and run strategy. I'm going to offer into this. I'm going to hit the bid, and 300 lots got taken. So the moment this starts going below 1,000 lots and it starts going aggressively, I'm going to hit this. And the moment I hit it, the moment I sell into this order, I'm going to be putting a buy order, a couple of buy orders all along here, between 3 to 6 ticks. I'm going to be looking for that little blip down and just fill all my positions when I do go short. So let's have a look how this trades for the moment. So we're watching here. So the moment we see it trade below, okay, you can see it accumulating here. There we go. Quickly, it's filled all those trades. It's gone from 35 all the way to 28. You would have been filled on your trades, and now your next strategy is looking for looking for after the hiding behind the elephant trade. So you're loading up some bids between 27 to 30. You can see the market is absorbing between this 27 to 30 range. So you've loaded up some bids and you're looking to exit again at around the 35s to 36s as the market starts gravitating towards where the blip started after that large order. So you start getting some longs away at the 50 to 26. So you've already cut in your reverse, and there we go. The market is blipped, all the way up. So as you can see, 3 strategies around observing a really large anomaly, large order. Not only can you execute on the front run, you can also execute on the hit and run, and then after the hit and run, you can cut and reverse your position, and then execute on the what we call the hiding behind the elephant trade, where as the large order gets taken out, it blips down, you find some buy side orders, or you load up your book and you look for a market to just start testing back towards where that large order got taken out. And that's really a great example of crude oil, the triple whammy play. These large orders don't happen too often, but when you see them, you have to optimize and profit from that trading strategy when you are faced with it.